Hello, everyone, and a very warm welcome to today's major markets update for January, not the 24th. I believe it is the 26th. Apologies for that one. 1, 2, 3, 4, 5. We are still counting that we are in wave 4 and still waiting for a wave 5, unless, of course, we break below certain price levels. Remember, all analyses are wrong to prove them right. That's why we have those cutoff levels. It's nothing else but risk management. That's all trading is, risk management. If the market goes up, you manage the downside risk. If the market goes down, you manage the upside risk. That's all there is to it. Do not overthink it. Be nice, be kind, and make sure you always lock in profits. So I have a lot of charts to share with you today. I wanted to share some of the warning signs articles I mentioned on Wednesday. Unfortunately, I can't find them anymore. They've moved to, I guess, some other webpage. It's fine. It's okay. It was mentioned. That said, this is the S&P 500 hourly chart. If we see a breakout above today's high, I am in the camp of 1, 2, 3, 4, 5 to 4,950-ish. That would be a ideal standard-based Fibonacci-based impulse pattern per the orange 3, 4, and 5. As you can see, orange 5 will then tag exactly the 200% extension for gray wave 5, etc. So this was last Friday's path we had outlined, and it's been followed reasonably well. On Monday, we got a little bit higher. That was anticipated on Friday. Then we kind of went sideways lower, but not as much as based on a standard Fibonacci-based ideal impulse pattern. Doesn't have to be, but clearly a orange 4. And then, of course, we went higher to the 161.8%. I think we missed it by about 60 points or 60 cents, something like that. Quite extraordinary. And now we are in a fourth wave, which might have completed already at yesterday's low. Okay. Now, fourth waves tend to be rather complex, and we'll have to see how this is going to fill itself in. We could still have a C wave lower. So we've broken below the first warning level, the blue one. It was at 4,880-ish, I believe it was. And we stabbed just below the first warning level at 4,860-ish. And we haven't gone below it since. We're back above the blue line. So the bulls are fully in charge, but you can clearly see we break below those two levels. We can have a more complex wave 4. Then we had wave A, wave B, and now in wave C. And again, the C wave will then target somewhere around 4860 plus or minus 10-ish, ideally. But we can extend to 4830, okay? Doesn't have to be, just as this orange wave 4 didn't go as deep as it should have. This gray wave 4 might not. And that fits with the theme that in bull markets, the downside tends to disappoint. We say tend because it doesn't have to. Sometimes it surprises, but most of the time it disappoints. That's why people say buy the dip, and dip buyers step in quite quickly as they are greedy and, of course, want higher prices. So these are the two counts we're looking for. Breakout above today's high. I'm in the camp for a rather direct move to 49.50-ish for this wave 5 of 5 of 5. If we break below at the minimum today's low, okay, that would be a very good signal that we're going to about 48.50 plus or minus 10, potentially as low as 48.30, and then we can still do wave 5. Remember, we haven't seen a wave 5 yet, unless this is the wave 5. That would be a very disappointing fifth wave that got even close to where it should be. Okay, that's not what I like. So on the daily chart, we have further support that we still need a smaller fifth wave. Let me adjust this one here for you right there. So because we're quite overbought, which is typical for a third wave, and so far it's only a sideways. We haven't even broken below this week's low, right? That's the first warning on the daily chart. The second warning scores above, break below this wave 1 high, and then the second warning is, of course, a break below the wave 2 low, and the final warning that we have really indeed topped is below the January 5th low. So remember, this can still subdivide. This can also be 1 of 5, okay? There's no guarantee it is 5 of 5, okay? So that's really what we need to strongly take into account that not until we've broken back below the January 5th low are we more certain that a much larger top is in place, be it the end of all, so to say, or we're going to get another 4 or 5. On a weekly basis, zooming out further, as you can see, we started with the hourly chart and we're zooming out further and further. On a weekly basis, it would look better with a target of 5,026-ish, so a little bit higher. And I'm still kind of missing a fourth and a fifth wave, even on a weekly basis, looking at some of the candles that we had here, wave 1, this is 2, and now 3. So to be determined, but that is still the ideal upside target, somewhere around there. Now, then we should always look at what other people are seeing, because we are not almighty knowing. And let's have a look at our friends at ElliottWaveTrader.net. This is posted on their public site. This is stuff from 3 days ago, where they were looking for the 3, 4, and then 3, 4, and 5. Okay, so far so good. 3 should top somewhere around 4,900. It did. 4 should then bottom at about 48.35. We might not get there. And then a 5 here to, again, the 49.50s, potentially a little bit higher. We don't know, can always go higher based on extensions that we can't forecast. We just go by what we know. Now, our friends at Elliott Wave Trader then have a 4 and then another 5 coming, okay? And that again depends on how you interpret this whole rally off the October low. So yes, it is possible that we see a 4 and a 5. I believe I have that on the NASDAQ chart, and I'll share that with you in a moment. So it is possible that once we reach about 4,900s, we'll see a pullback and then another rally. It is absolutely possible, okay? I cannot discount it just yet, but that would kind of fall then with our type of extension of a wave, and that the rally from the October 5th low will then continue. And again, it is here then again a target ideally at around 5,057, okay? Well, 5,057 gets us very close to 5,048 and 5,026. On these bigger picture timeframes and maps and charts, I'm not too concerned about that we might go a little bit higher. They even have potential to go to 5,200, 5,300, okay? It is all possible. We can still extend. It is still possible. Okay, that is still very possible. But again, look how close we're getting and this much larger topping zone we are now in. If we are going to top at, say, 5,050, and we're currently at 4,850, there's only 200 points left to the upside, all right? 200 points divided by 4850 is 4%. The downside risk is at least a revisit of last October lows. So please always keep things in mind, but I have zero indication that the top is in place. If anything, I'm still waiting for another smaller 5th wave higher to those ideal target zones at around 4,019, 49.47. Okay, so 4,090, 49.47, all matches quite well. Could we see the 4-5? Sure we can. I'm fine with it. It all depends on how we interpret this. I'm sticking with my own analysis, and this is just something we keep on the back burner. This is their analysis. I just wanted to make sure that on a shorter time frame, we are still seeing what other people that are highly respected at waivers are also seeing. Similarly, and she's back from having been absent for quite a while. This is work by our dear friend Xina Taubina. And she's also looking for 3, 4, 5 on the futures market. It's maybe a little bit hard to see, but if we zoom in a little bit, we should then have topped here for this wave 3 at around 4,930 to about 4,950. And I think that is pretty much what we got in the futures market. And we should now be declining for this wave 4 to about 48.80-ish. And that's also where we got pretty close to. I think we topped here at 49.07, so fell a little bit short here, but it's okay. Again, it's the same pattern, 3, 4, 3, 4, 5, right? That's what we're looking for. And that's what we're seeing. So we're well aligned with other people seeing. And then back to the bigger picture, this is work posted on Twitter or X called these days, for the S&P 500 by Zachary Manis, that we are very close to the 261.80% extension of the low made from the primary two low in 2010. Okay, this goes all the way back to 2010, and that high is at 4,920. So also this starts to suggest we're getting closer and closer to an important top. Now, I do want to point out that also here we have 5 waves up on the S&P 500. I have a very hard time counting it any other way myself, as you saw, of course, on the weekly chart. 1, 2, 3, 4, 5. I do not know how to count it otherwise because of the October low last year. This cannot be a 1, 2, 1, 2 setup anymore because this low overlapped with this high. So 1, 2, 1, 2. And then if this was a 1 degree smaller fourth wave, it overlapped with a potential 1 degree smaller first wave. That's not allowed. So I think this is the appropriate interpretation of the price action. And that then brings us 5 waves higher. Can we go to 5,000? Of course we can, but just wanted to point out also here, we're kind of running out of waves to count. Yes, we can still go higher. Oh yes, we can go to 5,300. Subdivisions are always possible, but just we have to keep in mind where we are in the bigger picture. Again, I'm not saying throw everything and the kitchen sink at it from a shorting perspective, abandon all ship from a long perspective, not at all. We have not broken below any single warning level, nothing, especially not even on the long term, nothing. So when that happens, you'll be in good time informed by me, and you know those levels to watch. So that brings us to the NASDAQ100. Well, that one's been a little weaker than the S&P 500. Obviously so, because the S&P 500 is a hybrid index. It is pretty much the Dow Jones plus the NASDAQ combined. And the Dow Jones did well today and technology did not. Yeah, people call it sector rotation, whatever. It's fine. But the NASDAQ 100 broke below its first warning level already earlier this week. Then it broke below its second warning level today, and that causes additional weakness. Now we are now in the ideal blue target zone for this orange wave C. Please remember here, the dotted lines is what we forecasted would happen last Friday. Okay, last Friday, this is what we have. A little bit higher, lower, higher, lower, higher. So far, so good. Well, we got a little bit higher, lower. Perfect, absolutely perfect. I do not understand the people that say the Elliott Wave doesn't work. I mean, you really have a problem because clearly it works. Can I forecast everything? No, we can't. Is this orange wave 4 less deep? Yes, it is. It happens, but the general path is right there for everybody to see. Okay, so if you call this trading the scribbles, it's fine. If you're not interested, then you zoom out and use the daily or the weekly charts. Those are all the different time frames I'm covering. So it looks like we indeed topped for this gray wave 3. This is now the deepest and longest pullback since the rally in mid-January started. So this is quite equivalent to this wave 4. And of course, if we break above today's high, it's a very good sign that wave 5 is underway to the 70,400, 70,000, almost 900 for this wave 5. Okay, so far so good. The whole path has been followed reasonably well. Okay, the only thing is this orange wave 4 didn't exactly go as low. Doesn't surprise me. It's a fourth of a third wave, and there's just serious buying. That's the whole point, right, of a bull run. And now, of course, we'll start to see nice negative divergence. This kind of looks similar to what we saw here, right? Here, here, and then we'll rally on more and more negative divergence. So the chart is set up for it. Oh, we can go all the way to 1710. Absolutely. Okay. We have so far, I would say, done the minimum retrace requirement to the 123.6%. From 161.8, 1/10 to normally. Ideally, textbook go to 100%, and then a 5 is 1 will target the 200%. But 5 can also be 0.764 times 1, and then we go to 176.4. If we stall here at 123.6, so we don't break below today's low, then that's it. And we could expect even going to about 18,000 plus on a 223.6% extension. I don't know. What I do know is there's some really big tech earnings coming next week. Apple, Amazon, Microsoft, Meta, and of course the Federal Reserve. So we're going to have a lot of market moving externalities coming that all have to be fitted in with the wave count. Daily chart looks good here for this wave 4. We haven't even broken below Tuesday's low. So all things are good. Zero signs of a top in place. And now we have our lower daily close. So this wave 4 is now confirmed. It doesn't have to be as deep as this wave 2. Could be enough. We'd like to see it go to the 100% extension, as I mentioned here. Doesn't have to. This is good enough. Okay, this is good enough. So if we break above, of course, today's high, it's a first sign. Wave 5 is underway. The gray wave 5. To again the 70,700s, 70,800 to 900s, potentially even 18,000 on a 5s1 relationship will get us to the 223.6. We cannot know that beforehand, but again, we'll raise, of course, these warning levels. If we go above this week's high, wave 5 is fully confirmed, then of course we can raise the blue line, the gray line, all that good stuff. Ultimately, we still need to drop all the way below the January 5th low to confirm that at a minimum, this black wave 4 is underway. Okay. Why? Because we can count, let me see here, zoom in a little bit more there, this as a potential 1, 2, 1, 2, 3, 4, 3, 4, 5. Okay, it is possible. This would be the 1, 2, 1, 2, 3, 4, 3, 4, 5. Okay, it is possible that we will see another 4, 5 setup. But of course, this wave 4 here will not be a doozy. It will be similar to this red wave 4, but probably deeper and longer in time. And that will be like a 10, 15%. Make it a 15 plus or minus 5% correction, maybe all the way back once again to the 200-day moving average. So we don't know just yet. I have here the B wave possible. It is simply how do you count October lows or the fall rally for 2022. We could have, for example, have had a failed 5th wave. It's this pattern here. Is this a leading diagonal? It's certainly possible. So this would then be black wave 4, 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, 5. So we're starting to get close to wrapping up this 5 of 5 of 5. This is still very possible. Okay. Negative divergences on the weekly chart are starting to, of course, emerge, but have not been confirmed. This is the regular NASDAQ. Also here, we've topped here, picture perfectly at a 161.8% extension for wave 3 of 5, excuse me, and are now in this gray wave 4. And we could have completed gray wave 4, but again, we can go all the way down to 15,150. I don't think so. If anything, we'll probably stall here at about 15,300, somewhere around there. I don't expect it to go much lower, once again, because downside tends to disappoint in bull markets. And then we will see our final rally into this ideal target zone for the wave 5 of 5. And let me show you the alternative that we are tracking. I'm not sure if it's on this one. No, it's not. Let me see if this one. So this would be the alternative. Again, it's a bit about how do we interpret the price action from the October low into pretty much December. I'm not going to cover this. So is it 1, 2, 1, 2, and then 3, 4, 3, 4, 5, right? Or is it 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4? So we get another 4 and a 5. Okay, that is still very possible. So that this one, of course, is going to be here, and I think we can move this one to about there. So are we then going to see another 4, 5, something like this? And this would then align what I mentioned with what our friends at ElliottWaveTrader.net are seeing. This 3, 4, 5, right? 3, 4, 5. It is possible. It's about how do you interpret this? Is it 1, 2, 1, 2, 1, 2? Or is it 1, 2, 1, 2, 3, 4? Okay, to be determined. That's why we put these warning levels out there, because we cannot get another 4th wave if we break below the January 5th low. Very simple. Dow Jones getting close already to our CSA or 3S1 target here at 38,200 plus, getting very close. Okay. No signs of letting up at all. So we can certainly extend on this one as well. Then we go to the 123.6 into the 39,000s. So we haven't broken even below the blue line, the gray line, the orange or the red line. So everything is still in a solid uptrend. Bigger picture wise, still only counts as 3 waves up from the October low, with this B wave of a potential irregular flat cycle A, B, C. And here is a very bullish alternative that we're in a ending diagonal 5th wave. This whole rally since the 2020 low looks better as 3 waves, 3 waves, 3 waves. Okay, so this is something to consider. It is possible. I have no indication it is true, but it is possible. Then we have an ABC for 3, ABC for 4, ABC for 5. Okay, and this would target somewhere again in the 45,000, somewhere out there. We do have, of course, tons of negative divergence on a monthly time frame. Okay, tons of negative divergence on a monthly time frame. But divergence only, divergence still is not. Price is a final arbiter, always is. Again, the Dow Jones hasn't even broken below the minimum level, which was yesterday's low, which is equal to Wednesday's low, which was equal to Tuesday's low. Haven't broken below it, so up and away we go. Very simple. We start breaking below that one, then we can target 37,400. Below that one, we target 37,200. Below that one, 37,000, etc. So this is a alternative. We'll keep it on the back burner in case we continue to melt up. Okay, it's very possible. So this is the semiconductors. It looks potentially complete for 5 for 5 for 5 for 5 for 5, etc., etc., etc. Haven't broken below any critical level. However, this rally here since the January 5th low is no longer than this rally here. And this rally now is the shortest. So this can't be a third wave anymore. Ding it. So we have to reassess our wave count. This could be our wave count now. Okay, so then we get 3, 4, 3, 4, 5. This would align reasonably well with our friends at ElliottWaveTrader.net. If that is the case, that would then align with this wave count, 3, 4, 5. It's all about how do you interpret the price action. Okay, so this wave count would then align also the semiconductors. Okay, but again, we're getting closer and closer to the final confirmation of this low. So then we have 1, 2, 1, 2, 3, 4, 3, 4, 5. And of course, we're just right here at the first warning level because we're back below the beginning of this week's low. Okay, so that's the first warning level. You never want to see that because if you start making a lower low, it is a first initiation of bearish things to come. And then it could be possible that this is all of wave 5. Okay. We haven't broken below the second warning level or the third or the fourth. So we can allow for this 4, 5, 4, 5 to materialize, which again would then match with our friends at ElliottWaveTrader.net. Again, it's about how do you interpret the rally from October into December. So let's keep an open mind. And again, there's no signs of the top in place. There's no signs. We're just seeing warning levels that we're getting closer, but I don't think we've even reached the minimum upside target, which I would believe is around 49.50s, okay? And I'm still missing a wave. It is possible here that we've completed this wave 4. Can still go a little bit lower. But again, if we break below about 42.40, this wave 1 high here, it starts to increase the odds we're not going to see this. So that's when why we use these alarm levels or warning levels to make sure that things are protected, because then we start making a lower low. We break below previous high, all those things, which is not a good sign. And remember, even if we go to new all-time highs, whatever it is, you can always rebuy. It's better to be safe than to be sorry. So that's all the indexes. I have nothing for the IWN, hasn't gone anywhere the whole week. So let's go to market breadth, and this is the NASDAQ Composite Bullish Percent Index. So how many charts that make up the NASDAQ 100 or stocks that make up the NASDAQ 100 are bullish versus bearish. This is based on point and figure charts that all go in here. And as you can see, 56%, so shortly of shy of 60%, just about half of all the stocks in the NASDAQ 100 are bullish per their point and figure chart. So we're starting to see potential negative divergence, dotted chart, okay? Just as we had here, no negative divergence between the beginning and the summer of 2023, and here, of course, all through 2021 into the end of 2021. Can take a long time. Till it finally mattered in 2021, 23% gain, followed by a 50% loss. Okay, that was quite the pullback. Here, till it finally mattered, 34% gain. Okay, and then followed by a 20% correction. There. Here, we have so far about 4% gain, and eventually this should matter. Can always be erased, but it will probably matter. AD line, still no new all-time high. Still concerned about this one. We haven't even broken back above this previous high, so we still have this potential for negative divergence developing. Just keep it in mind for the long term. How we're doing on the NEMO. The NEMO is back above 0, or NIMO, whatever you want to call it. I call it NEMO. NIMO. NIMO it is. The NIMO is now back above 0, so we have a buy signal. Doesn't mean it's going to be good times, because we've seen here that previous buy signals can turn into sell signals. So always make sure that you have your investment protected. How are we doing on the McClellan oscillator for the S&P 500? This is, of course, the McClellan oscillator for the NYSE. So it's a broader index. It's still negative. It's still -8. This whole rally so far since the January 5th low pretty much is on negative market breadth. It's not healthy. Again, this can get resolved as we saw here in May and June. Okay, so that might as well be the case. That's why price is the final arbiter. If you use this one for your buying and selling, you'd be doing pretty well. You know, you would have sold here, right? And then you would buy here, and you would sell there, and now you just sit on your hands. And similarly, he would buy here and sell there. Would have worked pretty well. You would have sold, etc. Buy. It works not all the time, but most of the time. Nothing works all the time. No market analyst works all the time. No technical indicator will work all the time. Elliott Wave doesn't work all the time because it's interpretive. So there's always something that's going to be hard to interpret. But this is a nice tool to have. Still no buy signal. So if you use it for buying and selling, you have to sit on your hands. Interestingly, as I said, this one is now on a buy signal. So it can be confusing, but pick one. This one is on a buy signal as well. And the KST has now confirmed the buy signal we got earlier this week. So this is a short-term uptrend. So that's good. Okay, it's good. It adds weight to the evidence that we're in the short-term uptrend. It's not the strongest of uptrends yet. And we'll have to see if we even get to the ideal topping range, because we know we can sometimes top out midway. But it's been a great run, and we're back to a buy signal. And again, let's go over what doesn't work. Seasonality is not really working. This is the average seasonality for election years for the Dow Jones. It should pretty much be downwards into late February, and we're not really seeing it. That's kind of odd. Okay, so we're not really following a election year pattern. It happens. It's just an average. So how are we doing then on a average 127-year basis for the Dow Jones? It's been okay. There was weakness, of course, into January 5th. It should have been strength. It's kind of opposite as well. We should now be in strength. Okay, so far it's not really working too much either. Should I just disregard all of this? No, we should always track it, because if it really is aligning well, then we keep following it till it doesn't. Right now it doesn't. just to show you nothing works all the time in the markets. What's neither working? Well, this is one of my pet peeves. The 10-year relationship between crude oil and the Dow Jones, meaning that what crude did 10 years ago should echo into the stock market 10 years later. Now, we should have topped then in January 22. We did for the Dow Jones, but then we should have made lower highs. I know this is a relative chart. I wouldn't make it absolute. The question now is, we are here. Of course, we're higher for the Dow Jones than where we were in 2022, January 2022. Not by much, but we are, of course. So are we going to see this pattern develop? Is the market completely going to miss this crash? And you can say, oh, this is too silly, it doesn't work, all that stuff. Right now, it's not working. The thing is, this is being brought to our attention by the McClellan Financial Publications, Tom McClellan, a fantastic analyst. We don't always see eye to eye. I disagree on some things, but this has been working for over 120 years reasonably well. But he also says that it doesn't work all the time. Okay, it depends. So, for example, when a major geopolitical event puts a thump on the scale for oil prices, the message of the oil market does not necessarily get repeated by the stock market. Okay, so it doesn't work all the time, but it's been working most of the time to know that we should pay attention. I mean, there's too much correlation to make it coincidental. Okay, doesn't have to be always exact, but it's too much correlation to make it coincidental. Look at this, 1929, 1920. So oil peaked in 1920, the market peaked 10 years later, 1929. Oil peaked 1933, the market dropped to 1933, and we got a market bottom 1942. Okay, 1948, 1958, 1960s, 1973, kind of flat. Same here, 1982, 73. Okay, so we got here, I would say the scare of 81, and that is not really found then in this decade. But we had the high in 1990, which brings us to 2000. We had the low here in 1998, which brings us to a low 2009. 2008 brings us to 2018. Of course, we had a major high 2018, etc. So there's enough information to say, you know what, this works really well. 1892, 1902, 1898, 1907. You see, it's pretty interesting. So now why it's not working at the moment, I don't know. On the other hand, 10-year relationship with a 1-year difference is still not all that much. But it does still tell us that we should expect something dramatic later this year, starting somewhere around the summer. Wouldn't surprise me. So, you know, this is something to take at heart. It doesn't, again, mean you should abandon ship, but let's keep tracking it. It doesn't work right now. It hasn't worked for a while. It's okay. Things tend to get back on track. Okay. Sometimes they inverse, but in this case, I think we're going to get back on track. So please remember that. So we can't dismiss just things that currently aren't working. That's just because nothing works all the time, but everything works some of the time. Anyway, this is our analysis for this week. So please keep an eye on those levels. We see breakouts above today's high. I think we can target 49.50 for wave 5 of 5 of 5, ideally, with, of course, the caveat that we might only see a 3, another 4, another 5. It's very possible. It would kind of fit reasonably well with the semiconductors as well, because the rally since the January 5th low is now so long that it makes the December rally the shortest wave. That's not allowed. So I have to reassess it. So this would start then to match also with what the assessment is by our friends at wavetrader.net. It's all about how do you interpret the October to December rally. It is not the easiest of rally because there's so little subdivision going on, right? Is it 1 2 1 2 3 4 3 4, or is it 1 2 1 2 1 2 3 4 3 4 3 4? Again, if you miss one first wave at the beginning, you're going to miss one fourth and fifth wave at the end. So we'll keep on tracking, knowing that this is now our alternative bullish wave count for now. And once we reach our ideal target zones, it is time to reassess. Okay. And please remember that when one index tops, it doesn't mean another index tops. The technology sector already topped November 2021, and the S&P 500 and Dow Jones had to wait pretty much 2 months before they topped out. So things can always go sideways if you would do a one blanket approach. So the NASDAQ topped, so everything else must have topped. Not the case. Look even at the small caps. I'm not covering today. They're in a completely different world. And please remember, it's going to be fireworks next week, most likely with big tech earnings that can move markets, and of course the Federal Reserve. Also, what I want to point out, last but not least, let's have a look at some interesting charts, which is oil. Oil is breaking out. This is USO, United States Oil Fund. It's breaking out. It looks pretty bullish to me. As you can see, we're above the 200-day moving average. We're now back above the Ichimoku cloud. We've been below it ever since November. And as you know, if oil prices go up, everything goes up. Why? It's going to get more expensive at the pump. Transportation of goods is going to get more expensive. That needs to be translated into goods getting more expensive to recover some of those extra costs. The XLE is also starting to break out back above its 200-day moving average. This looks reasonably bullish as well. Look at these candles. So I just wanted to point out that if this is the case, it's going to be a lag time, of course. But if this is the case, that we might see higher prices going forward. Inflation is not going to be back to 2% as everybody thinks we will, and that it will be a Goldilocks soft landing. It seems often that we get bitten in the butt by these type of things, and it's not a Goldilocks scenario. So just pay attention to this, and if you want to make sure you pay not extra at the pump, I would say be long energy sector and oil. It's not a trade recommendation, but then the profits you can make out of this trade, you can use to pay off the extra charges at the pump. Take care, trade safe, have a great weekend, and I'll catch you all next week.